Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Denison Mines is the best performing stock on the TSX today. You can see it's up more than 12%. The Canadian uranium company says it's ready to begin constructing its uranium mine in Saskatchewan once it gets final government approvals. The project is poised to begin producing uranium by mid-2028 and set to become Canada's first major new uranium mine since Cigar Lake. Denison warns, however, that total costs for the project are now estimated at about 20% higher. It will be more than $500 million. Shares of furniture retailers Wayfair and RH are getting a boost. That after U.S. President Donald Trump pushed back a tariff increase on some imported goods. The move delays a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. The higher tariffs were due to take effect on Thursday, but are now set to go into effect January of next year. Trump says the move is due to ongoing trade talks. However, a 25% tariff imposed in September will remain. Tesla reporting a bigger than expected drop in fourth quarter deliveries, also posted a second straight decline in annual sales. They fell nearly 9% compared to the year before, while deliveries fell 16%, missing Wall Street estimates. The EV maker has been struggling to boost demand for its vehicles following the withdrawal of tax incentives. Investors also noting concern about the automaker's 2026 sales targets. Well, the price of aluminum climbed above $3,000 US a ton for the first time in more than 3 years. The jump is due to a cap on Chinese smelting capacity as well as constraints to European production due to higher electricity prices. Both have chipped away at global inventories. The demand outlook from the construction and renewable sectors are also contributing factors. And looking at the markets, well, they're holding on. They're in the green right now to start the new year after a rough finish to 2025. It's still, the year was up 28%, so no complaints that way. But good to see it in the green to start the year. And taking a look at the U.S. markets, and there you go. It's been a flip. It started out strong, and then all of a sudden it's just taken a turn right now. You can see the S&P 500 off by 0.12%. Dow Jones still in the green, but barely right now, and it looks like it's going to slip below. And the Nasdaq is off by 0.3 after being up almost a point to start the new year earlier today. It's been a year many in our country have come together, united by a common goal to stand up for Canada. That includes the premiers of the provinces, the territories. Team Canada is what they were called. They came into focus in 2025 as the front line of the trade fight. But as CTV's Andrew Johnson shows us, old interprovincial rivalries are also being renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state.
We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up 90 to $1 a gallon, they will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like, the answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May, when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone to...
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the three-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They knew it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories and trying to get along. Andrew Johnson, CTV News, Vancouver.
Well, no surprise, the price of oil is fluctuating on the first trading day of the year. You can see, what's it off now? It's off by 1%. WTI down 56.82, still not down to those 5-year lows that we saw last month, but down yet again. There are expectations that a supply surplus will offset geopolitical risks to production in several OPEC plus nations. Let's get more on this from Kelsey Keane, Director of Equity Capital Markets at the National Bank of Canada. Kelsey, thank you very much for joining us.
Thank you for having me.
So oil looks like another rocky road forward again in 2026. It was not a good year, 2025.
Yeah, exactly. We're off to a rocky start once again, and the outlook going forward is a bit uncertain. If we look back at 2025, we saw a significant decline in the economy. There's lots of news adding to the price volatility, geopolitical uncertainty. There's more news on Russia, Ukraine. And I mean, investors are looking towards December 4th with the next OPEC meeting.
January 4th.
January 4th, yes. And, you know, they're bracing for oversupply and uncertainty around that demand.
And so what does that mean then, if that's what we see come out of that meeting?
Well, I think that we are going to be looking at oil potentially declining and a lot of fluctuations, at least in the near term, until there's a stability.
And in near term, what's near term to you? And And stability. What is stability?
I mean, in the current world, near term can be a week, it can be 6 months. It's hard to say. There's a news cycle that's changing every day.
And so, what do you do as an investor? What do you do with oil if you're in there?
I mean, if you're a Canadian investor and we look at the index, we are heavily weighted in commodities. I mean, there's metals and mining as well as energy. So I think it's important for investors to understand, what's their risk and reward in their portfolio, diversification, and then seeking out quality names with strong and stable earnings.
And what's the concern with OPEC Plus, with their meeting and with Canadian oil in Alberta?
Well, I mean,
is there an impact? I mean, obviously.
Yeah, I mean, I think let's take a step back. I think globally, I think there's just concerns about oversupply. And then if we look at the macro, there's just a lot of economic concern. And where is that demand going to come from to feed into that supply?
Okay. And then obviously Russia, internationally, Russia. Is Venezuela as much of a concern now? Like we saw the embargo and there was a bit of a reaction, but now it seems to have kind of calmed down a little bit.
Yeah, I think all of this news is really impacting what investors are doing. I think they're taking in all this information and they're bracing for what's going to happen. It's still very early days in 2026, but the outlook is still a bit shaky.
Okay. And then bigger picture, equity markets for 2026, how are things? We had coming off a great year.
Yeah, exactly. I mean...
we won't talk about the last few days of the year, but we're coming off a great year.
Exactly. I mean, energy aside, I think there's a lot investors have to be excited for in 2026. From where I sit, it's really exciting when we see strong equity markets. And here are some of the tailwinds that I see. Supportive monetary policy. There's lower interest rates. There's continued demand for AI and tech-enabled industry. Commodities, outside of energy, so if you think about precious metals, have been very strong. And there's been an uptick in M&A activity, specifically cross-border M&A. So all of this is adding to a positive outlook, not without concern.
We'll start with the rate cuts then. There's talk there's probably going to be 2, maybe 3 possibly.
Yep.
What if we don't get those in the States?
I mean, what we're looking for in the market is what's being said is going to happen is going to happen. So, I mean, if we get less than the expected rate cuts, that could have some negative impacts on the market. If we kind of meet the status quo,
it's all factored in.
All factored in, exactly.
And in Canada, there was, I did hear talk, seems to have disappeared a little bit, then we might see a hike at the end of the year. Depending, but.
Yeah, I mean, I think everything's a little bit uncertain at the moment. I think there's some indicators in the economy that we could use another cut. So I believe investors will be looking forward towards that.
So you think we'll see another cut in Canada?
I think there's a potential for that in the upcoming year.
Okay, what might be the deciding factors, do you think? What might drive that?
Well, I think it's a couple things. I think we always look to our neighbors in the South to see what they're doing and how that impacts our economy. Right now, there's a lot of uncertainty around, the trade negotiations. We're looking towards a renegotiation of NAFTA in the upcoming year. So depending on how all that unfolds, we're going to see how the economy reacts and then what the central banks decide to do.
And of course, CUSMA is the elephant in the room.
Yes.
It could be great.
Exactly.
And it could be an absolute nightmare. And can the markets even factor that in, right? Like, because it's such a swing?
It's interesting. 5 years ago, I might have said markets wouldn't know how to react. Yeah. Markets have gotten accustomed to a little bit more volatility. And even with all this news going on in the market, if you look at the volatility index, it's relatively stable. So I think there is, an adjustment towards how investors' behavior approaches these news events.
Okay, now of course the other big thing is AI and tech. Do you feel this is the year where, is this the year AI has to do something?
Yeah, so we're coming off a very strong year. The TSX was up around 30%. A lot of that is driven by large cap and a lot of that by this tech thematic. There is underlying concerns that, there's a lot of supporting industries as well that are supporting the AI move. And if we don't see the demand that we're looking for, could there be a trade-off? I think it's important to put all of this in context too. Equity markets have been quite strong. Valuations are high. So we could, if we don't see strong earnings out of these AI companies, we could be seeing some tempered valuations going forward.
So people moving their money around.
Exactly.
Okay, Kelsey, we're going to wrap it up there, but thank you very much for joining us. Happy New Year.
Happy New Year.
All the best in 2026.
Thanks, same to you.
That was Kelsey Keene, Director of Equity Capital Markets at National Bank of Canada. Coming up, the new Free Trade and Labor Mobility in Canada Act will come into place in 2026. More on what that means next. Amid this trade war and evolving relationships between the provinces, the new Free Trade and Labor Mobility in Canada Act will come into place in 2026, changing how provinces exchange goods and services. CTV's Jeremy Sherrill has more.
It's a promise the Prime Minister made often in 2025.
So we're building one Canadian economy.
A pledge to remove barriers to interprovincial trade announced last year that today came into effect. Bill C-5, the Free Trade and Labor Mobility in Canada Act, now means provincial requirements for goods and services and workers' licenses will be recognized federally too.
I think symbolically, it's a really good way to start off the year. Actual impact, I think it's really more the provinces than the feds that we're looking for action from.
A separate mutual recognition agreement signed by all provinces and the feds is set to be implemented by June. It will further impact interprovincial trade, but still, experts say some key goods are excluded and still face challenges.
Alcohol, right? Beer, wine, spirits is one example, right, that we hear a lot about. And so there are still ongoing conversations at the provincial level to make it easier to move those goods across borders.
While 2025 saw governments across the board push to trade more within the country, several bilateral agreements were signed between provinces. Experts say 2026 needs to be about follow-through.
There needs to be tangible action on the ground this year, and it needs to come quickly because the CUSMA threat is hanging over all of us.
On the international front, the stakes couldn't be higher. Canada's free trade agreement with the U.S. and Mexico is up for review this year, only putting more pressure on bolstering the domestic economy.
I think it's fundamental to our ability to respond to the threat from the United States, from the tariffs, which probably aren't going to go away soon, even though we have the possibility of a review of the CUSMA.
Formal talks are set to get underway in the coming weeks ahead of a July deadline, when a decision will have to be made on whether to extend the deal as is, negotiate a new one, or either country could decide to walk away.
Coming up, Wedbush's Dan Ives says 2026 is an inflection point for the AI revolution. We'll hear more from him when we come back. As we start 2026, Wedbush's Dan Ives says that the time is an inflection point for the AI revolution. For more on why, our Bloomberg colleague sat down with Dan earlier today.
It's really about, to me, it's about the second, third, fourth derivatives playing out across AI. Look, it's monetization. And you talk about Tesla, it's the next phase in terms of autonomous, robotics, consumer AI, especially when it comes to Apple, and I think what we're going to see. Look, I think it's a prove it year, but that actually makes me more bullish because I think now we go into the next phase of AI. I think tech stocks are up 20, 25% in 2026, but it's not just big tech, it's about second, third, fourth derivatives playing out.
I will be fascinated to see. I don't think anything is officially expected, but you're going to CES, right, which is not only the biggest tech conference in the world, but has become the most important car maker conference as well. It'll be fascinating to see if Tesla comes out with any other products there, or if we see a lot more robotics and automation products.
Yeah, and to your point, look, it all starts with the godfather of AI, Jensen. He'll be there with the black leather jacket because when his speech, to me, is just so important on Monday, because it really starts off strategically what AI is going to look like. He's going to talk about physical AI in terms of autonomous robotics. I think the two best physical AI plays in the world today, it's NVIDIA and it's Tesla. And I think that speaks to you about like Tesla, what everyone's focused on. This is autonomous chapter now coming to Tesla. I think you see Musk right now, wartime CEO. That's the focus when it comes to AI, but also it's the monetization. Remember, only 3% of U.S. companies have gone down the AI path so far.
Are these robots expected to be like B2B robots, so building things in factories, or like a Roomba for consumers? What kind of products do you expect them to monetize?
Yeah, especially at CES. Look, humanoid robotics is going to be front and center. Autonomous. You're seeing flying cars. A lot of the presence. You talk about a lot of the tensions between U.S. and China. The presence of Chinese companies is going to be. It's going to be a monster in terms of what we see there. I think doubling over the last few years. But I think it's really going to be about humanoid robotics. It's going to be about autonomous, but this is also going to be about more embedded AI devices that consumers are going to see. CES, we're not just talking about flying drones and refrigerators that talk to you. Now these are much more sort of front and center in terms of it's a who's who. Every big tech player is going to be there, even if they're not unofficially there. They're there to look for acquisitions.
I love the idea of opening the refrigerator and having it say, "Do you really want that?" I mean, I can just imagine the future for, move over Ozempic. So there's this question here also about what some of the moves in late 2025 mean. And I'd love your take on this, because we saw some acquisitions made by the likes of Meta and NVIDIA. And I just wonder whether there's more cost consciousness and more of a competitive advantage that they're looking to solidify at a time where suddenly companies are saying, hold on, what are we paying for this and what are we actually getting?
Look, I think you hit on a great point, because the reality is it's an arms race. That's what's going on with big tech. And right now, at the top of that mountain is big tech. And when you look at like Google's win versus DOJ, antitrust, I mean, this is sort of go time for big tech. And I think you're going to see more and more acquisitions. And we've talked about not just on enterprise, on energy, and I think really across the board. And it speaks to really what we're seeing right here is that it's not just about big tech getting bigger and bigger, doing acquisitions, spending. You're going to have $600 billion in CapEx in big tech, but it's also you're going to see other players being like, don't forget about me. Look at AMD. You're going to see like, look at Cisco, look at IBM. I mean, there's going to be a lot of other players saying like, hey, we want to get into that AI party. We don't want to look through the windows. Like a lot of the bears are.
We were talking about BYD triumphed over Tesla to become the world's biggest electric vehicle manufacturer. We also have seen big tech in China outperform on an equity market perspective in 2025. Do you expect that to continue and for China to really solidify more of its neck-and-neck position with the U.S. or even supersede it?
Look, I think the reality is for the first time in 30 years, the U.S. is ahead of China when it comes to tech. And I think that's very important, obviously led by NVIDIA, Microsoft, Palantir, and others. But in China, look, we're bullish on China tech. We talk about Alibaba, you look at Tencent, you look at a lot of the other names there. I think what you're seeing is it's a narrowing, but it's something where you're seeing robotics really play front and center, autonomous, EVs, BYD, and others in China. But when you think about how to play it, you have to play U.S. tech, and then there are Chinese tech players to go after. But in terms of AI revolution, like we've said, it's third inning, one out, relative to this AI game. And I think the bears, like I said, like in hibernation mode, they can see AI in the spreadsheets. And I think 2026 is going to be a year that's going to be another bull market year for tech and for AI.
I had really the same question as Lisa, again, because we've seen so many stories this morning about Baidu's chip unit filing for an IPO, another chip designer, I think Breitner, with a very successful IPO today, maybe another mini DeepSeek moment, right, with a cheaper artificial intelligence, all among the most read stories on the Bloomberg terminal. So clients are paying attention to what's going on in China with AI. How do you bet on that? I mean, do you buy the individual stocks? Is there an ETF that you like? Do you have some of these stocks in your ETF?
Yeah, sure. So obviously, for the IVES ETF, I mean, what we really focus on is the AI 30. It's like, who are the 30 winners? We have a few of the Chinese players in there. I think Baidu, you look at Huawei in terms of the success they're having. Look, right now, NVIDIA's 4 to 5 years ahead of any other chip player. And I think that's well known. That's why even a third-rate H200 restricted, China big tech's going to line up despite what the politics in Beijing. But this is an arms race. It's the narrowing of the gap. You want to play some of those Chinese tech players, but the reality is in the U.S., from NVIDIA, AMD, we talk about our top 5, Palantir, CrowdStrike, and cybersecurity. Tesla, I think it's going to be the most important year ever for them. Microsoft, I think on hyperscale right now, Microsoft, Oracle, those are names, I think, table pounders, in my opinion, in terms of what we see. And then Apple, finally, they come to the AI party instead of being on the treadmill at 2.0 speed. And now they actually start to get in terms of the consumer AI revolution, $75 to $100 per share.
There's only one company that you didn't mention that's on your list, and that's Microsoft. Where is Microsoft in terms of winning out versus Google? Who is its main competitor?
Look, in terms of Redmond, the enterprise, this is their backyard. When you think about companies that are moving to AI, the first phone call goes to Nadella. And I think you're seeing Google, you're seeing Amazon, what Jassie's doing, they're narrowing the gap and they're going to be successful. But when I look at Microsoft, you have 25, 30 billion incremental monetization. I don't even think it's factored into street numbers. That's right, in the stock ultimately has a 6 in front of it. And I think this is going to be, we're going to go into January, into earnings season. I think that's going to be kind of the show me story, showing like, look, this is not stopping. Like we said, AI party started at 9 p.m. It's now 10:30, 10:45 p.m.
Me and Lisa are asleep.
Yeah, 100%. That's exactly what I was thinking.
But the party goes to 4 a.m. And that's where we are.
That was Wed Bush's Dan Ives with our Bloomberg colleagues. Up next, we'll have more insights on what's driving retail trends in 2026 and what it means for consumers and businesses alike. Stay with us. Oh, oil continues to struggle. It's off by a little more than 1.25 point right now. You can see for the year it's down 20.96. There are a lot of expectations that a supply surplus will offset geopolitical risk to production in several OPEC plus nations. OPEC is leaning toward caution, with key members expected to reaffirm a decision to pause supply increases during the first quarter. The International Energy Agency has forecasted a glut of about 3.8 million barrels a day for this year. Shares of Ivanhoe Mines are trading higher, up 1.7% right now. The miner says a smelter at its Kamoa-Kakula complex in the Democratic Republic of Congo produced its first copper anodes. Ivanhoe says the smelter's ramp up to 500,000 tons of copper will be completed toward the end of this year, and shipping nearly 100% pure copper anodes instead of concentrate. And that will cut the project's logistic costs in half. Shares of Sable Offshore are up 19% right now. The company has received the go-ahead to restart a contested pipeline. A federal court has ruled that Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California. And looking at the markets right now, what started out as a good start to 2026 is now kind of a wash right now. Composite TSX is barely up 0.02, hardly worth mentioning right now, after finishing slowly in 2025, but still up for the year at 28%. South of the border, another mixed bag. You can see it's jumping. Last time we looked, they were all down. Now the S&P 500's up slightly, not much worth mentioning, but the Dow Jones is up 0.3, and the NASDAQ is down slightly, but had been down about 0.3%. So it's all over the place today. Okay, we're going to dive into the retail outlook for 2026, which largely follows a shift in economic realities and cultural trends that will shape what we buy and why. Joining us for more on this is Jessica Ramirez, co-founder and managing director at the Consumer Collective. Jessica, thanks very much for joining us. Happy New Year.
Happy New Year, and thank you for having me.
Okay, what are we looking at? I think there's two very distinct lines, isn't it, when it comes to consumers?
Yeah, so, 2025 was quite a difficult year. We repeatedly said, the consumer is shaky, the sentiment is quite tough out there. And the consumer that was most hit was middle income and low income. And I think that is only going to be, we'll only see more of that into 2026. If I think about what I've already seen in terms of credit card debt, that has already gone up. The consumer did shop for the Christmas season, but again, we have to factor inflation into that. So how does that really look into once we get those numbers? And with the high income consumer, I think we've continued to see them spend, but even they are being quite cautious. So again, I'm still giving a bit of caution where retailers will really need to hone in on how they manage their business, which they did do a good job in 2025, managing low inventories and still, dealing with tariffs. But I think the consumer is still going to be very laser focused on what they're shopping for.
Okay, let's talk first a little about the higher end consumers. You say they're going to be a little more cautious. What's driving that?
I think, despite what we're seeing in the market, there is a lot of excitement, obviously, around AI, but I think that there's still this question of, is there a bubble? And I think in terms of that market, that is the high-end consumer who is investing. And I think in terms of investment we've seen a lot around jewelry, and that's been really good in luxury. That market has continued to do very well. So we see that that's a key investment where they feel safe. If there is a trade down, even with food, we've seen some of that even through Walmart, Costco, how the high-end consumer started trading down in some versions of grocery. So I think that's still something quite interesting to look at as indicators. I mean, they are still spending regardless, and they had last year, they did hold the majority of the retail sales up, accounting for 50% anyway of what we saw. But I think that there is still a bit of caution behind them.
Okay, and now for consumers on the lower end of the K, are they really hitting that point where they're almost completely tapped out?
Yeah, so we had done a survey last year ahead of Christmas, and most consumers told us, and it was 75,000 and less who were earning, and they told us they were either out of savings or had been dipping into savings. We also heard that they've been doing much more buy now, pay later, which has increased by a lot more into some of that. Dipping in. So again, that's new debt that we've seen. And most recently, we've seen some credit card data where it seems they have increased their debt today. So that really just seems to be, are they buying mostly for essentials? Are they buying, when even it's grocery, we started seeing Hamburger Helper last year really gain. Again, thinking of how much is that food going to last me instead of 1 day, is it going to last me 2 to 3 days? So again, very, very targeted in the way that they're seeing their spend.
And so what should brands be thinking about as they head into 2026 with this information?
I think in terms of what is the consumer really interested in and what are they willing to purchase? Because even on the middle income and low income consumer, as we've seen the price hikes come through, if an item, say in sportswear or in wellness, is a bit more expensive, they are actually purchasing that item. They may not be purchasing a ton of it, but they are purchasing those items. So is it something that the consumer is really wanting to spend on? Does that product offer quality even at a higher price? Value today doesn't necessarily mean that they're looking for a bargain. That's something going to be cheaply made. They are looking for something that's going to be long. We've been seeing the consumer really focus around longevity. So what does that mean in terms of wellness? Is that supplements? Is that food? Is that, what else are you adorning yourself with today if you're going out running or if you're going to work? And how's that going to make you feel better about yourself? And resale has also been something we've really been looking at in the luxury sector and also just across the board. And it's also coming from a quality standpoint. I think we've been hearing a lot about questioning what does luxury look like in terms of quality and are these prices justified, where consumers are actually going back to resale and buying some of the original items at a different price.
Okay, I want to ask about some themes that we can expect for 2026, and I want to throw in there, food is fashion. And
yes,
just curious as to what that is.
Yeah, so what we've seen a lot of is there's been, again, with the high-end consumer and the consumer being so focused on wellness, and we've seen this GLP halo effect. And I think with that is, what am I putting into my body? But also at the same time, almost like a status symbol. And you see different marketplaces coming in with higher end foods, making that a very fashion-y standpoint. And, it's almost of where do you shop, of where are you seeing kind of thing. There's merch that's being added to a lot of grocery stores, and they might be small delis, they might be something else, but there is this cachet that comes with it. And that's really where we're seeing food as fashion, where it becomes a sector that the consumer is spending on. And again, just a very much bring in high status, which we've seen that with restaurants as well, where what are consumers eating? And we see that also with the younger generation. They seem to really be caring about that part. So again, it's an interesting category of spend and just getting a glow up, I would say.
Okay, we have to wrap it up there, but Jessica, thank you very much for joining us. All the best for 2026.
Thank you, same to you.
Jessica Ramirez is co-founder and managing director at the Consumer Collective. Coming up, we're starting the new year with a review of mergers and acquisitions last year and what's to come for 2026, right after this. Premium Brands and Stampede Culinary, Synovus and Meg, possibly Netflix and Warner Brothers. These are just a few of the big name mergers and acquisitions in 2025. So what can we expect for 2026? Let's bring in Mackenzie Regent, managing partner of Kalos LLP and director on the board of directors for the Chartered Business Valuators Institute. Thank you very much, Mackenzie, for joining us.
Thank you very much for having me. Good morning.
Before we look ahead to 2026, let's look back on 2025. And what kind of a year was it for M&As?
Well, I think there was originally a little bit of trepidation around tariffs and what that meant for market uncertainty, what to expect for the year. But really, when you look at 2025 globally, the year was a decisive rebound. Global deal value is projected to reach $4.8 trillion by the end of the year, which is really a 36% increase year over year. And really what we're kind of seeing is the idea of uncertainty is the new certainty, and deals will continue regardless of the prevailing market conditions.
So does that mean companies are adapting and realizing they have to move ahead no matter what?
Yeah, it feels that way. There's a lot of dry powder on the sidelines, and I think market participants are using, value bridges, contingent payments. No one really has a crystal ball, but I think there's an idea we can't just wait on the sidelines forever and see, and so let's get capital deployed and moving, and using structuring as a bridge to get that done.
And were there certain regions or certain areas that we saw more M&As?
Well, I think what we're really seeing in 2025 was kind of a year of the merger. There's more mega deals on record, both globally and locally in Canada, than we've seen in a long time. From the Canadian perspective, we saw 63 deals in excess of $10 billion, and it represented a 147% increase in year over year in terms of the normal deal size that we see. And so I think we're seeing strategics really lead the charge on how to bring companies together and be stronger from that perspective.
And what is some of the focus of those strategics, and what were some of the deals with Canadian companies? What's the bigger ones?
So one of the ones that we've seen recently here locally in Calgary is the Synovus and Meg deal, totaling $7.9 billion and creating one of the largest oil sands platforms. And really what you saw here was a great example of how deal tension can really return value for shareholders. And so when you look at the original Meg offer, it really kind of effectively represented a 0% premium. And then Strathcona intervention ended up driving a better premium for shareholders. You've also seen kind of a continued tailwind for cross-border transactions, notwithstanding some of the noise injected from a tariffs and trade war perspective. And so we recently actually just saw today that Premium Brands announced it has closed its acquisition of the Stampede Culinary Partners. Premium Brands is based in BC, and Stampede, notwithstanding being in Calgary, is actually based in Illinois for $688 million U.S. transaction. And we're really seeing strategic companies looking at how to diversify their supply chains and create natural hedges amongst all the uncertainty we're seeing in the markets.
And now we have to talk about AI. What kind of a factor is that when it comes to M&A?
Yeah, it's really shaping both deal flow and execution. So nearly half of all strategic tech deal value over $500 million involves some kind of AI target or AI rationale to the transaction. And over 75% of acquirers assess AI impact when they're pursuing a transaction. Then also on the professional services perspective, you really have to be thinking about how you can insert AI into your data analytics and business intelligence processes in order to drive deal insights.
And how are they bringing AI in then? And are we kind of at the max, or is there always room for more changes?
I think it's really just kind of starting to get into its infancy. There's a lot of base repeatable tasks that you can use machine learning and automation to deliver a lot of that. We've seen some of the large banks announce layoffs from a trader's and other perspective. But I think at the end of the day, there's still a lot of gray area where professionals, you mentioned me being a part of the Charter Business Valuator Institute, especially amongst all the uncertainty that we're seeing right now, there's this underpinning of past doesn't necessarily equal future. And so you need professionals who can look at the data that's being aggregated by AI and machine learning to really interpret, so what does this ultimately mean, and still provide those insights to deal participants.
Still need that human perspective.
Absolutely.
Okay, Mackenzie, thank you very much for joining us today. All the best for the new year. We appreciate it.
Thank you very much for having me.
Mackenzie Regent is managing partner of Kalos LLP and director on the board of directors for the Chartered Business Valuators Institute. Coming up, we continue our look back on 2025 and Canada's changing immigration landscape. Stay with us. An influx of millions of immigrants welcomed into Canada in recent years has been blamed for the rising cost of rents and overstretched public services. The door has slowly been closing, though, for many foreigners, and a new federal government calling the Trudeau-era policy unsustainable. CTV's Adrian Goldborough with the backlash and the consequences that have the country charting a new course.
Canada's once ambitious immigration targets have led to a hard landing.
We're reducing the numbers of immigrants that will come to Canada for the next 3 years.
The former Trudeau government acknowledging they made some mistakes. In 2022, Canada welcomed more than 405,000 newcomers, with plans for 465,000 permanent residents in 2023, 485,000 in 2024, and 500,000 in 2025.
Did we take too long to adjust? I think there's some responsibility there.
The government eventually reworked its plans to decrease its target to 395,000 permanent residents this year, while lowering that number even more over the next 2 years. The about-face set in motion a seismic shift in Canada's immigration policy that has played out over the last 12 months.
We've got this huge influx of people on Canadian soil expecting permanent residence who won't get it.
The number of international student visas were slashed this year, leading to college and university program cancellations and sweeping job cuts.
We're seeing one of the largest mass layoffs in Ontario's history.
A cap on international student permits that began in 2024 and into 2025 will see a further reduction in 2026. As Frost Weeks rolled onto campus this year, international students were taking note.
A lot of international students dream of studying abroad. I have a sister. She might be wanting to study abroad, and caps like this are affecting her.
It's a concern shared by Canadian university executives.
60% decrease in the number of new students approved to attend Canadian universities in the first quarter of this year. They, in fact, help pay for more spots for Canadian-born students to attend university because international students pay higher tuition fees.
Ottawa put a limit on foreign students in part to help ease the pressure on the cost of rental housing while trying to reduce the burden on hospitals and other public infrastructure and social services. Citizenship Canada says its aim is also to create a pipeline of international student graduates whose skills match the country's long-term economic and labor needs. Adding eligible fields include healthcare, social services, education, and the trades. In his first news conference in May following the federal election, newly minted Prime Minister Mark Carney pulled in the reins on immigration even tighter.
We will return our immigration to sustainable levels by capping the total number of temporary workers.
That led to an outcry from some labor groups, even a lawsuit against the federal government, filed by a conglomerate of Quebec-based businesses who claim they're losing money and now unable to fill vacant job postings.
These companies either have to slow down production, refuse contracts, and in certain cases, they will even close down certain shifts. We can think of weekend shifts, night shifts, because we can't find the workers that we need.
The Carney government has pressed on, promising to cap the level of foreign workers and international students by less than 5% of the country's population. The 2025 federal budget highlighted that in 2018, 3.3 83% of Canada's population were temporary residents. By 2024, that number had more than doubled to 7.5%, an unprecedented rate of growth that put pressure on housing supply, the healthcare system, and schools. Canada's new government recognizes that this system is no longer sustainable.
We will work to attract the best talent in the world to build our economy.
The recent spike in the country's population has in part resulted in nearly zero GDP per capita growth over the last number of years, meaning the slice of the economic pie is getting smaller for each Canadian. A country built on the back of immigration has now recalibrated as it charts a new course into an uncertain economic future. Adrian Gobriel, CTV News, Toronto.
Let's take a look and see how things are looking on Bay Street and Wall Street. And you can see the TSX still up, barely though right now. One of the stories for the day, Denison Mines ready to begin constructing its uranium mine in Saskatchewan. The Canadian Uranium Company says as soon as it receives final government approval, it will start work. Should be open by 2028. First new uranium mine since 2014, Cigar Lake. And taking a look south of the border, you can see it's a mixed bag again. It's been all over the place. The NASDAQ is off again by 0.36%. The S&P 500 also down by 0.2%, and the Dow Jones is up barely. It's really just a wash. One of the stories, though, coming out of the U.S., Wayfair. Take a look. How's it doing right now? It's up 6.45% after President Donald Trump delayed tariff increases for a year on upholstered furniture, kitchen cabinets, and vanities. So Wayfair is benefiting from that one there. All right, Market Call is up next. Today on the show, we have Dan Rohinton. He is Vice President and Portfolio Manager at IA Global Asset Management. He'll be taking your questions on global and Canadian large caps. Thanks for watching Morning Markets. I'm Roger Peterson. We'll see you back here on Monday. Have a great day.